Welcome back. You're watching Wealth Manager. International funds is one of the avenues to get a global exposure and diversify your portfolio. But given the volatility in the global markets, how should you pick the funds to invest in? Feroze Azeez, Deputy CEO, Anand Rathi Wealth Management, joins in. Thanks, Feroze, very much for joining me. Let me start by asking you that for those who really want a global exposure, is this a good avenue to really invest in?
Yes, of course. If someone wants global exposure, the best method is using a mutual fund, especially a feeder fund. So, to answer your question, is it a very good method to take a global exposure? One of the best.
Okay.
To a retail investor, global exposure and dollar exposure, basically, when you buy gold also, you get a dollar exposure.
Right.
In the most retail guys actually buy gold, inherently they buy dollar. Is this a very unitized, small quantum investment to a large quantum investment? Using this as a global exposure, definitely one of the best platforms to do so.
If you look at the kind of performance that they've given in the past 1 year, you've had all your gold, Latin American or commodity linked funds that have given negative returns as much as 30 to 40%. And the funds that have actually done well are the US based funds, which have performed relatively better in fact. So what is the outlook for international funds?
See, international funds, clubbing them all and generalizing them is not something we should do. Because anything outside India is international, and that's the entire world. So if there could be a fund which could be investing in foreign US, such an emerged economy, so you will have lesser volatility than India. But if you go to Latin America, which is not such an emerged economy, you will have large volatilities. So if you come back to the question of what's the outlook, I would say using mutual funds to invest not in some themes like the commodity which you mentioned, it's a disastrous idea to say the least, because you don't understand the territory, you don't understand the subject either. So using the platform to invest in US or any emerged market is what I think is the most important. Not going to even emerging economies, because India is one of the best emerging economies. So you don't
might as well invest here.
What you don't have here is lesser volatile equity. Indian equity is far more volatile, almost twice as more volatile than US equity. So that's not something which is available to you. So use it for something which is not available, which is especially US equities is what I would recommend a starter to get in. The bigger advantage is to get the dollar currency advantage. If the rupee depreciates, the NAV actually gets a benefit 1:1 on it. And that's directly correlated. The NAV will actually go up if there's rupee which depreciates. It's a hedge against rupee's depreciation. So using the fund to invest in the global space only from emerged economies, especially US, would be a brilliant idea actually.
So if one has exposure to the funds that haven't performed well at this point, what is the advice? What should one do? Just exit those funds and put it elsewhere?
See, if those funds are thematic in nature, gold mining companies, there are funds which do that. Some commodity based, or is as an emerging economy group basket, then you need to surgically remove them and get rid of them and not be very patient waiting recoveries, because those recoveries could be perpetual as well. So if it's funds which are fundamentally funds which have been existing for long periods of time, those and they are into US or large emerged economies funds, then you need to just stay put in them, because that as a strategy will work out. So I think that's what's very important. But categorizing your fund into two. There are funds which are feeder funds. Those funds, the global funds which are feeder funds, have funds which have been existing for 15, 20, 25 years. And the Indian fund has been set up just 1 year back to actually feed the fund into an old fund. Those are stable, track record oriented funds. So those don't have to be worried about. There are some funds which collect the money and actually invest it. And that's the fund's inception, 2 years, 3 years. Then those are the funds which you would actually want to be shying away from and actually removing them off your portfolio and cleaning it up.
So when it comes to things like the taxation part of it, how do these funds really pan out for that?
See, of course, because it's a global fund, it is actually treated as debt taxation. And since it's a global fund, the return expectations are not too steep. So indexation comes to your rescue. Only that you will not be able to exit it in a year's time, and you will have to hold on for 3 years. So tax, of course, is detrimental when compared to Indian equities using the mutual fund platform, because those are considered debt in spite of investing in equity. From a taxation standpoint, they're considered as debt. But if you have a 3 3-year time frame and indexation comes to your rescue, since the return expectation are not those 20, 25, 30, unlike in India, I would say indexation will save a large portion of the tax. But yeah, it's detrimental, of course.
Okay. And in terms of expenses, of course, since these are fund-of-fund platforms, the expenses would be higher. But how much higher is that?
But there are caps applicable to these.
Okay.
There is not too much of a difference, about 0.5% kind of a difference. The cumulative charge is also capped by SEBI on these funds. So it's not like if 2% is the cap, then 2 plus 2, 4 is the cap.
Okay.
But generally they are more expensive by about 50-70 paisa,
okay.
Or 0.5 to 0.7%, which I think is not too much to spend.
Okay. So what are your recommendations for somebody who wants to invest in a couple of these international funds? Any particular funds that you recommend? I
would say the best fund which can form part of your core portion of your portfolio and stay there for long periods of time would be the Franklin US Equity Fund, which is a feeder fund. And so the core fund, the actual original fund in which the money actually gets pumped into has been existing for a couple of decades. And the fund manager has also been stable for almost more than a decade and a half. Okay. So I think that's one fund which can form a part of your core portion of the portfolio. Franklin US Equities is the best fund to my mind. Not from a return perspective, from a stability and more of a risk mitigant perspective.
Okay. And from one's mutual fund portfolio, what percentage should be, or how many funds should one have in the international fund space?
I think for anybody, I don't think more than 2 funds ever, but 1 fund should be good enough as a starting point. Okay. And I think anyone should not expose himself to any fund, irrespective of the geographies, not have more than 8-10 funds. So having one global fund or maybe a US fund should suffice, and at most 2 of those. Okay. And in terms of percentage in the portfolio? Anybody having more global goals should have 20%. Anybody who does not actually
just
have
from a hedging perspective?
12%. That's good enough.
All right, we'll leave it there. Thanks very much, Feroze, for joining me.
Thanks.
With that, it's a wrap on this episode of Wealth Manager. To catch expert opinion and views on how to make your money work for you, log on to btvin.com/wealthmanager. If you have any queries or comments, do write into us on wealthmanager@btvin.com. Thanks for watching.